Good morning, everyone. My name is Nelson Hibner. For those who don't know me, I'm the head of Latin America, Spain, Portugal, and Israeli business at UBP. It's a pleasure to have you all here in our webinar. Our last meeting took place in Lisbon in January 2020. However, due to the current situation, we decided to adapt and host this second semester meeting via web. I would like to introduce our CIO, Mr. Norman Villemont, who will share us his thoughts on the economy in the upcoming year of 2021 and what to expect. After this session, we will open the floor for a Q&A session. So please feel free to type in your questions. You have a space where you can write them. Bom dia a todos no Brasil. É um prazer tê-los aqui. Meu nome é Nelson Hibner, eu sou o responsável pela área de Latinoamérica, Israel, Espanha e Portugal no BP. Nossa última reunião foi em janeiro de 2020, em Portugal, mas devido às circunstâncias a gente teve que se adaptar e fazer essa nossa segunda reunião de Investment Outlook via web. Eu vou apresentar o senhor Norman Villemont, que é o nosso CIO. Ele vai falar um pouco das perspectivas para 2021. Quando essa sessão terminar, mais ou menos 25 minutos, talvez um pouco menos, feel free, vamos colocar as perguntas no sistema e ele vai responder. Então, Norman, please take the floor.
Thank you, Nelson, and thank you, everybody, for joining us. For those of you who have joined our Outlook sessions, either in person when we were last in Lisbon or online as we did last June, most of you will remember that the way we like to kick off these Outlook sessions is kind of look back at what we said at our last Outlook and take a scorecard, if you like, of how we've done. So if we kick off on the first slide, looking back at what we talked about in June, and remember, June, we were just coming out of, if you like, the lockdowns in many parts of the US and Europe. There was still great uncertainty about the pandemic. And this is where we focused. Essentially, we were looking for recovery, but it was going to be a very bumpy recovery. And that story very much played out as policymakers in the US, Europe, China worked very hard and in a coordinated fashion to avert any type of credit crisis from moving around the world. From that perspective, risk management was going to be a very important part of our story. And indeed, that worked very well. Gold performed very well as we expected, and an active risk management style was very valuable for us through much of the second half of this year. From an equity perspective, again, we were of the view that equity and credit were both expensive from here, but we wanted to stand next to central banks and take a quality approach. We did think there was going to be quite a lot of risk in terms of defaults, which we are seeing, but if you take a quality approach and a growth bias, that was a great way to position in equities. On the bond side, interest rate volatility was going to be a story for us as we thought the markets were going to swing from optimism to pessimism about the prospects for recovery. And we've seen that, in fact, in the government bond markets. And the key message for us there was really looking through the interest rate volatility and focus on spread compression and standing by central banks as they try and repair the global economy. And indeed, that has worked very well for us here in the second half of the year. And then overarching a lot of these themes was the story of US dollar weakness. And indeed, we've seen that really play through across a number of currencies we see today. Euro dollar is up in the 119 area in particular. And we think that was a key story in terms of helping repair the global economy. So as we look forward, one of the places that we want to begin really is what is the outlook that we see for the global economy? As you can see on the following slide, what we see in terms of the economy is effectively a recovery. So on the left, this is mobility data out of the US and Europe. Effectively, this is how much are people moving around in the economy. And you can see in March and April, essentially, the economy shut down, and then we had a gradual uplift. And now with the virus in particular in the US and Europe coming back, you're having this steady slowdown in activity again across both regions of the world. In contrast, I think if you look in the emerging markets, we've had a very difficult summer month it'll be the winter in the Southern Hemisphere in terms of the virus. But now we're starting to see the same cycle come into play where we've seen the peaks in the infections. Those are starting to ease, and now these economies are starting to reemerge, much as the U.S. and Europe did over the summer in 2020. And so this is the mindset that I think we need to approach the economy now. We have not only the economic cycle that we need to think about in terms of consumption and investment, but we also have a virus cycle that we need to think about. The good news is each time we move through these cycles, we're learning from them. And so even though we're seeing shutdowns, for example, in Europe, they're not as devastating as they were in March. And the policy response to these shutdowns has been very proactive. So the cost of these shutdowns to these economies are less meaningful from here. And so that's how we're thinking about it in terms of the economies. So where we are right now, we're in kind of a stable place in terms of economic activity. And as we go forward, though, we think the virus has the potential to shift the dynamic meaningfully. So even though the economies have recovered somewhat meaningfully after they've emerged from lockdown, you can see on this right-hand panel, the consumer understandably remains very cautious coming out of the lockdowns. So consumer confidence in just about every region of the world is below where we started the year at. And so if we get the vaccine, if it's deployed, and if it's effective, the prospect that you see the consumer coming back much more strongly and providing another impetus to the recovery story in 2021, we think is something that we want to keep in mind as effectively a catalyst going forward. One of the other reasons why, if you like, this new case growth that we're seeing in different parts of the world is a little less concerning is on slide 7. Remember, this whole pandemic began at its center in the second largest economy in the world, in China. So you can see here in February, China was already in recession when the lockdowns across the rest of the world hit. And so you had this headwind. China, obviously an important demand driver for many of these economies. You contrast that to where we sit today, even though we're seeing slowdown in the US and in Europe because of these new outbreaks. China, in contrast, has not only moved into recovery mode, but now shifted into outright expansion mode, largely because they've been able to keep the virus under control through their very aggressive testing, quarantine, and tracing measures going forward. And so from that perspective, even though the numbers that are reported in the press in places like Europe and the United States are worrisome, I think it is important to recognize each cycle is a learning cycle of the pandemic, and the policymakers are learning how to adjust. And in China's case in particular, China is now representing some stability in terms of overall world growth. So from that perspective, we're a bit more constructive moving into 2020 about the world growth picture because we have the base of China plus the prospect of vaccine gives us uplift in terms of consumer demand as we move through the year. Now, on the other side of the equation is really the Federal Reserve, European central banks, and policymakers around the world. Even though we are seeing some of the data start to recover, a lot of people and a lot of the questions I'm getting relate to, okay, what's going to happen in inflation? Are interest rates going to go up? How should we be thinking about this? And if we were in a normal economy, I would probably say, yes, this is something we want to worry about. But we're not in a normal economy. We're in this brave new world that we think about. And why this is going to be different has to do with this idea of permanent unemployment. And where you can see here in the global pandemic, this red line, the amount of job loss in a short period of time has exceeded really any recession going back to the 1970s. And so from that perspective, the Federal Reserve in particular has no appetite, and they've been very overt about it, to start raising rates or changing their policy environment until this unemployment issue is dealt with more fully. And so you have this, if you like, stability recovery story moving through with a prospect for upside surprising growth driven by not only stimulus, but also the vaccine that should come in 2021. And on the other side of the equation, the Federal Reserve, central banks around the world remaining very accommodative in light of some of the permanent damage that has taken place to their economies. So as we move to the next slide, one of the key questions with that comes through has to do with, well, yes, that may be the case, but isn't the market already pricing that? Things are very expensive. It looks like 2000. Shouldn't we be worried? And look, let's be fair. Valuations are not cheap in the markets. And we said that in June, and we'll say that again now. You can see that valuations today look very similar to what we saw at the turn of the century. But what we want investors to focus on is not the similarities between valuations, but instead the difference between where we are in the earnings cycle. So if you were investing in 2000, the thing you'll remember is valuations were quite high, and then markets fell, and you lost a lot of money. What really catalyzed that decline in valuations, you can see on this right-hand panel, is this turn in the earnings cycle. So earnings were actually accelerating from 1998 into 2000, and then earnings growth started to slow. And then by 2001, earnings growth was actually negative. And that's when you started to really get hurt in the markets. If we look at what's happening now, obviously going into this pandemic, earnings growth was already slowing. What we've seen in the second quarter of the year, earnings growth has troughed at roughly about minus 25%. The third quarter, we've seen that steadily improve. We expect the same in the fourth quarter. And as we go forward, earnings growth should actually accelerate going forward. And so that means we're at a different point in the earnings cycle than we were in 2000. So earnings are going to be the keys to how you drive returns in 2021. And from that perspective, we're actually quite constructive from here, not only in the U.S., and we'll talk about what's happening in the U.S., but we think the dynamic of global recovery will play through throughout the world economy and throughout global equities. So if we look to slide 9, one of the key questions we get is, are the technology names, have they run too far? Shouldn't I shift? And if you look at what's happened over the course of the year and why technology and growth stocks in general have done well compared to more traditional sectors of the economy, energy, banks, industrials, the key difference is what's happening to sales. For a lot of these growth names, sales have actually grown. Not very much, but they're positive. Whereas on the flip side, a lot of these old economy names, sales have contracted and contracted a lot, almost 20%. And so to get this to reverse, it's not only that you need to see the growth story come under pressure, but in particular, for a lot of these more old economy names, you need to get sales going. Now, fortunately, we think that's going to happen in 2021. You can see on the right-hand panel, a lot of the manufacturing data that comes out tends to lead sales growth. So as we move forward, sales growth should turn from negative, so roughly speaking, negative 15, 20%, to positive between 5 and 10% going forward. And that should be the inflection that you get in terms of some of these cyclical sectors. So what we're doing in portfolios, we are starting to move into some of these cyclical sectors, things like industrials, things like miners, places where balance sheets are relatively clean, industries have consolidated, and you get this nice leverage to recovery going forward. And we think that's a tactical trade as we move into 2021. Beyond this, one of the big questions and big concerns, if I'm honest with you, a lot of our clients have is what do I do with some of these really nice growth stories, these secular trend stories that have been in play for the last year? And so in slide 10, what I've done is try to frame this dynamic in a longer term time horizon. I was investing at the turn of the century in markets, and this was a time when we were all talking about internet revenues don't matter, everybody can make money. And obviously in 2001, 2002, people lost a lot of money in the internet stocks from here. However, that in the grand scheme of things was a relatively small blip on a long cycle trend that we now in retrospect can realize if we had ridden through would have made us even more money than that short-term volatility. And that's how we're thinking about these transformation themes. We do think the pandemic, we do think the lockdown has triggered one of the most important accelerations in transformation of the global economy for the better part of a century. And so that means a lot of the themes that we've been talking about and focusing on in 2020, things like artificial intelligence, things like the cloud, or things like healthcare, will remain stories going into 2021 and beyond. But what it also means is, as investors, we're going to want to broaden out our reach in terms of some of these themes. So for 2021, we've added things like fintech, financial technology, digital currencies, things like from healthcare to online delivery of healthcare services, moving in from exporters and technology in China to things like domestic China. We think these are a number of themes alongside with what everybody is talking about, which is climate change. We think these are the themes that will be the versions of internet and the versions of biotech 10, 20 years ago. And we want to make sure we have a strong allocation to these thematics going forward. If we shift paces a bit on slide 11, the other question we get from a lot of clients is, how do I generate income in this world? So it used to be this was a problem for European investors, for Swiss franc investors, for Japanese yen investors. But for dollar investors, you were in a reasonably good shape. You could figure it out. But now we're in a situation where even dollar investors are having a difficult time generating meaningful yield going forward. And if I'm honest with you, this problem likely only gets worse. And why do I say that? You can see on this first panel in slide 11, the yellow bar you see, this is basically the US corporate bond market and the yields one generates in this market. And then the line in green is essentially the Euro corporate bond market. The Americans and the Europeans are learning from each other in terms of how to handle their policies. And so the playbook the American central bank is effectively running is what the European Central Bank has run for the last 7 years. And so unsurprisingly, you're seeing US yields fall, not quite negative, but at, let's call it below 1%, very similar to where German yields were right after the European crisis. And European spreads compressed to roughly about 100 basis points. US spreads are moving in the same direction. And the next question, the next leg is, do the Americans follow the Europeans and drive spreads to a point and yields to a point where after inflation, they're actually negative? We believe that increasingly that's a direction they're going to go. And so the answer to how do you generate income in a low yield world or even a no yield world, we want to draw from the experience of being an investor in the European bond market. So what did you need to do in that sense? One, you need to push out the risk curve a bit. You want to stay quality in credit, and so you want to do active credit selection from here. And so in Europe, that was moving into the high yield space. In the US, we think it's moving into the high yield space, but we think it also involves moving outside of necessarily the traditional US corporate credit market. It means moving into things like emerging market credit, where we think yields and spreads can continue to come in. One place where we've deployed money, especially for those who don't have so much risk appetite, is the Chinese government bond market. You can see here, Chinese government bonds are yielding more than 3% in a currency that we think strengthens meaningfully against the dollar going forward from here. And then outside of that, we think investors increasingly are going to have to look to the private debt markets to generate yield. So getting paid effectively for illiquidity and getting paid a liquidity premium. So the solution to generating income in a no-yield world or a low-yield world involves a little bit more risk on the credit spectrum, moving off of your own yield curve and moving to effectively emerging market or international yield curves, and then moving to more illiquid strategies like private debt or even alternative strategies like long-short credit, which in combination can get us to a point where income investors can have their needs met. If we move to slide 12, another area of focus we think is going to be currencies, especially for income-oriented investors from here. One of the things we've seen going back to the 1970s is that as we come out of recession, invariably you see a weakening in the dollar and a reasonably steep weakening in the dollar at that. And so not a surprise, we do expect the dollar to be fairly weak as we go forward into 2021 and 2022. We mentioned on the previous slide, we think the renminbi can strengthen fairly meaningfully. And I think this is a great chart to illustrate the gaps that we're seeing between some select currencies. So just from a pure interest rate differential period, you see here, the renminbi can be substantially stronger given the strong yield advantage that the Chinese currency carries. On the flip side, if we look, for example, to Brazil, in contrast to China is running positive real yield environment domestically. Brazil, in contrast, is running negative. And so this is one of the things that we want to be fairly careful of. In the emerging market space, we want to be fairly selective about the currencies that we're focused on. We think Brazilian real probably weakens from here. That allows the government to keep interest rates relatively low to help sustain the recovery going forward. And that weak foreign exchange rate will end up being very supportive in an environment of industrial recovery around the world, especially for commodity-oriented exports going forward. And so we think that's a policy tool Brazil will use in particular. If we contrast that, for example, to Mexico, just because of their proximity to the United States and the recovering United States economy that we see next year, we actually think Mexican peso probably can strengthen a bit from here, maybe closer to 19. And so as investors, we want to be focused on currency as a driver to return as well. So from our perspective, again, we like renminbi. We do like Mexican peso a bit here. And in the more developed world, we think euro dollar probably moves into the 120s and the mid 120s from here as well. And then we think the commodity currencies should do quite well in the developed world. So the Australian dollar, the Canadian dollar, and the New Zealand dollar going forward. If we move on to slide 13, I want to touch on two risks that we think, I almost forgot. Precious metals and industrial metals. One question we get quite a lot from investors is gold has had a bit of a rough time of it over the last 3 or 4 months. How come gold isn't moving? And the answer really has to do with the fact that, if I'm very honest with you, the Americans let us down in terms of stimulus. We had expected they were going to come with more stimulus that would have pushed inflation higher and driven inflation-adjusted yields lower. That would have given us this next leg of appreciation in gold. But as we move into next year, as we get the vaccine, as we get some stimulus in the pipeline, certainly from Europe, but potentially from the US, we think gold probably moves into, again, the 2100 type of area to 2200 type of area from here. So a very attractive return going forward. And then outside of that, we think the industrial metals look very good as we get this reflationary policy moving forward. And in particular, things like silver and palladium, which should benefit from the climate change oriented investments that should take place over the next 5 to 10 years, not only in Europe, but also in China as well. Moving on to slide 14. The two key risks I want to focus on are, one, inflation, and then the broader geopolitical shift that we're seeing in the world. A lot of people are concerned because of the amount of money printing taking place that inflation is going to run away with us from here. If we look at the last two economic cycles, so the global financial crisis and the tech bubble, effectively what we've seen coming out of the pandemic is inflation is performing very similar to those cycles. And so it's not going to surprise us too much if we see, let's call it 2.5% inflation in the back half of 2021. It's after that, in 2021, 2022, that we think central banks are going to make a hard choice about whether they allow inflation to run hot. So for 2021, we're not so concerned that inflation picks up too aggressively from here. One of the things we are a bit concerned about is how the post-Trump era shakes out in terms of the globe's relationship with China. We're already seeing some conflict between China and Australia. The Biden administration has said they're going to be multilateral, so working with Europe, working with Australia to try and effectively redefine the relationship with China. But as we've seen on the border with India, as we've seen in the South China Sea, and vis-a-vis Taiwan, China, the conflict does seem to be heating up. So this is something we want to focus on as a risk that we want to protect against going forward. So if we move to slide 15, just to sum up some of the key points before we go to the Q&A. Again, from a recovery perspective, I know the new cases in the US and Europe are concerning, but when we look at that in the context of the policy responses and the much more controlled slowdown we're seeing in the economy, we think that is a temporary slowdown in the context of overall recovery. And so we want to focus on recovery from here. And alongside that, a bit rising, volatile inflation, but still contained inflation going forward. What does that mean for you as an investor? We want to focus on equities. Yes, valuations are high, but focus on earnings growth. And there's really two areas to focus on earnings growth. There's the cyclical stories where quality cyclical positioning is going to offer a good opportunity as sales growth recovers in 2021. And then there's these transformational opportunities that we want to make sure we have a good anchor position in, because like internet or biotech before, we think they have long runways and we want to continue to participate in that long cycle earnings growth they're going to deliver. For income-oriented investors, it is really a focus on much more modest expectations and then moving off of your home yield curves, looking internationally, looking at private markets, private debt, long-short credit, and even more FX-oriented returns going forward. And again, we walk through, we want to be selective in the emerging space. The euro, commodity-oriented currency, should do quite well to add to total returns from a foreign exchange perspective.
I would like to remind you that we have our brochure about this presentation in our website, and it's in different languages. So you can find them in Spanish, English, German, many languages. So thank you very much. I hope to see you next time physically. But anyway, we will be here for your doubts. Muito obrigado a todos. As questões que não foram respondidas, a gente vai responder por e-mail. Por favor, coloque ainda suas perguntas, ainda dá tempo, Norman vai responder. No nosso website, a gente tem essa apresentação, então, por favor, fiquem à vontade de entrarem e olharem. E eu espero ver vocês em breve fisicamente. Até a próxima. Obrigado. Thank you very much. Muchas gracias. Tchau.